Welcome to The Explainer. Today, we're diving deep into the story of Meesho, the zero-commission giant that is absolutely shaking up e-commerce in India and is now gearing up for a massive IPO.
All right, here's how we're going to break this down. First, we'll get a handle on just how huge they are. Then we'll unpack their unique zero-commission model. After that, we'll look at their path to profitability, dig into the philosophy behind their strategy, see what they're betting on for the future, and finally wrap up with what it all means for investors.
So first things first, to really get what Meesho is all about, you have to understand their incredible scale. And these next two numbers, well, they're pretty staggering. Just let this one sink in for a second. 1 out of every 6 people in India is a Meesho customer. That is an absolutely insane level of market penetration. And all those customers, they placed nearly 2 billion orders last year. That kind of volume makes Meesho the single largest e-commerce platform in the entire country, just based on the number of transactions alone. So the big question is, how in the world did they get so big? Well, it all starts with their kind of radical, totally counterintuitive business model. They charge their sellers zero commission. And that, of course, leads to the question that everyone asks. If the sellers aren't paying a commission, how on earth is Meesho making any money? The answer to this really unlocks their entire strategy. So they have 2 main ways of generating revenue. First up is logistics. They make a small margin from sellers who use their super efficient, low-cost delivery network. And the second is advertising, where sellers can choose to pay to promote their products and get more eyes on their listings. But, this kind of high-growth model always brings up that one giant question, especially for a company about to go public. Are they actually profitable? And here's where Meesho really starts to think differently. Instead of chasing what we traditionally call net profit, their main focus is on something called free cash flow, basically the actual cash the company has left after paying for everything. They see that as the true sign of a healthy business, and by that measure, they've actually been cash positive for the last 2 years. And you can see their efficiency getting better and better right here. By handling about 65% of their own orders through their logistics network, Valmo, they've been able to consistently lower the cost of every single order they ship. Okay, so if they're getting more efficient, why are recent reports showing that their net losses actually got bigger? That seems like a contradiction, right? Well, here's the key. This wasn't a mistake. It was a strategic choice. They saw a window of opportunity where it was really cheap to bring on new customers, so they decided to hit the accelerator. They consciously chose to invest in super aggressive growth to expand their user base while the getting was good. And this focus on the long game isn't just about the numbers on a spreadsheet. It's actually rooted in a core principle, a philosophy that really guides their whole business. The founders are just fundamentally against the idea of surprise platform fees. They believe it completely breaks the trust they've worked so hard to build with their sellers and customers. And for them, that trust is their most valuable asset, something they are just not willing to trade for a short-term profit bump. You can also see this long-term thinking in where they're deciding to invest for the future. They call these future growth areas Horizon 2 initiatives. You can kind of think of them as little internal startups. Once they prove an idea can actually work and scale up, it graduates and becomes part of the core business. It's a really clear roadmap of what they're planning next. And right now, they are betting big in 3 key areas. First, financial services, with things like buy now, pay later, tailored for their specific customers. Second, they're using AI to make online shopping feel more like a real conversation. And third, they're scaling up their unique platform that connects over 50,000 influencers directly with sellers. All right, so let's pull all this together. With an IPO getting closer and closer, what's the big picture for someone watching this company? What's the bottom line? The story of Meesho really comes down to a classic tension between huge strengths and some pretty big challenges. On one hand, you've got incredible scale, a super efficient cost model, and deep customer trust. But on the other hand, they still need to turn all that into consistent net profit. They've got to fight off fierce competition, and they have to convince the public markets that their very unique model is the one that's going to win in the long run. And all of that leaves us with the final big provocative question. Is this high-growth, trust-first model the real future of e-commerce? Or is it a long-term bet that might just be too risky for public markets, which, let's be honest, often demand profits right here, right now?